Investors. I'm joined by Daragh Quinn, an analyst for Nomura in Madrid. Thank you so much for joining us. Good to talk to you. So investors obviously very concerned about Spain's banks. Signals from the bond market not very encouraging at the moment. So are financing costs likely to ease back anytime soon?
I think the bond auction today could go reasonably well. Certainly the markets are putting Spain under additional funding pressures, but I think really until the underlying solvency concerns of the Spanish banks are met, things are going to remain challenging for Spain.
So what needs to happen for those concerns to be met? What do investors, what do the markets want to see?
Well, I think what the market wants to see is additional capital put into those banks that need it. The Spanish central bank, the Spanish government are making efforts to deliver additional transparency to the market in an attempt to show the exposure to real estate. But I think most of the market is concerned that the losses being faced by the Spanish banks will be greater than currently assumed, and therefore additional losses will have to be booked and capital will have to be raised to absorb those losses. So effectively we're talking about additional capital being put into the banks from the private sector if possible, and if not from the FROB.
Yeah, because you're estimating a capital requirement for Spanish banks of between 43 billion and 80 billion euros. Is that correct? Of course, depending on the severity of the losses, will the largest savings banks be able to raise equity directly in the markets?
Well, that's correct. We're in a stress scenario. We're estimating potential losses of between 40 and 80 billion across the system. Now, of course, there are quite a number of banks in Spain, and they will have different asset quality experiences, so the scale of losses will vary across the different banks. Now, the savings banks legislation has been changed to allow the savings banks to access the private markets and raise equity directly. I think that would certainly be the plan of a number of the savings banks. A different question is whether the market will give them enough time and access to that money, or to raise that money. Potentially, if depending on how the bond markets go, or their ability to access refinancing, they could need to access money from the government before being able to raise money from the private markets.
And I guess a big part of the problem right now is the fact that investors believe that the losses in Spanish lenders are being hidden.
I don't think so much as being hidden as that there are still additional losses to be borne. The experience the market would have seen with Ireland is that the initial estimates of losses, weren't sufficiently high enough. I think in Spain, certainly the busting of the property boom and the economic slowdown hasn't been as dramatic as in Ireland, and therefore potentially losses are coming out at a slower rate. Certainly there have been significant losses already, but I think the market, looking at the scale of the property lending boom in Spain and the experience we've had with the Irish banks and property losses there, would leave most people feeling concerned that there are still additional losses to be borne.
Great.